The fourth quarter 2025 report and subsequent strategy update released by Aker BP on February 11, 2026, represent a juncture for the company as it navigates the complexities of a capital-intensive growth phase on the Norwegian continental shelf. This period is characterized by a deliberate shift from high-output stabilization to an investment cycle aimed at sustaining production above the 500,000 barrels of oil equivalent per day threshold well into the 2030s. While the quarterly financial results were visually marred by significant non-cash impairment charges, the underlying operational metrics, efficiency, cash flow generation, and exploration success suggest a robust fundamental core that remains largely decoupled from short-term accounting volatility.
Analysis of positive and negative vectors. The following synthesis categorizes the most significant factors influencing Aker BP's valuation and positioning following the Q4 2025 report. Negative aspects and risks. Several developments in the Q4 report suggest that the company is facing increased headwinds. Cost inflation at major projects. The 19% cost surge at Valhall PWP Fenris to $7 billion is a stark reminder of the risks associated with large-scale developments in a tight labor and materials market. Accounting losses and impairments. The $944 million impairment in Q4 and the resulting 93% drop in annual net profit create negative headlines and suggest a more difficult path to profitability if commodity prices remain suppressed. The 2026 production valley. The projected dip to 370 to 400 MBO EPD in 2026 will lead to lower EBITDA and higher unit costs, requiring the company to lean more heavily on its balance sheet. Rising debt levels. Net interest-bearing debt has reached $7.09 billion, and while liquidity is high, the rising leverage ratio could limit the company's ability to pursue further major acquisitions in the near term.
Positive aspects for the company. The most compelling argument for Aker BP lies in its operational consistency and organic growth engine. Operations. The 96% production efficiency and $7.30 full-year production cost demonstrate an industry-leading operational foundation. Exploration alpha. The ability to participate in all major NCS discoveries in 2025 has significantly de-risked the 2030-plus production profile and added over 100 million BBOE of high-margin resources. Dividend growth. The 5% increase in dividends during a peak CapEx, lower production year is a powerful statement of financial strength and management confidence. Project acceleration. Pulling forward the Skarv satellites and Utsira High developments into 2026 showcases the agility of the company's subsea tieback strategy.
Part 2. A comprehensive analysis of Aker BP's Q4 2025. Operational performance. The moat of high efficiency. Aker BP's operational execution in the final quarter of 2025 underscored its status as a premier operator on the NCS. The company achieved a net production average of 410.6 MMBOE/PD, which, while slightly below some market consensus expectations, remained firmly within the updated guidance range for the full year. This performance was underpinned by a production efficiency rate of 96%, a metric that serves as a primary protective moat against the escalating costs of offshore operations. Production dynamics and sales realization. The discrepancy between production and sales volumes in Q4 2025 provided a temporary boost to top-line figures. Due to an overlift position of 20.8 MMBOE/PD, the company reported sales of 431.4 MMBOE/PD, effectively accelerating the monetization of its inventory. This overlift, representing approximately 5% of the quarter's output, was a key driver in the company's ability to beat revenue consensus despite declining realized prices.
The realized prices for the quarter reflected the broader softening of the global energy markets. Liquids were realized at $63.01 per barrel of oil equivalent, or BOE, while natural gas prices averaged $59.02 per BOE. The blended realized price of $62.06 per BOE sat roughly 2% below the Brent benchmark for the period, which is considered a standard differential given the transportation and quality adjustments typical of the NCS portfolio. Asset level analysis, Johan Sverdrup and beyond. The Johan Sverdrup field continues to function as the financial engine of the company. In Q4 2025, the asset delivered high production efficiency and maintained exceptionally low operating costs, even as management began preparations for the field's transition into its mature phase. To counter the natural decline expected in the coming years, Aker BP has announced an extensive drilling program for 2026, which includes 9 infill wells and the Tanger appraisal well on the northern flank. This proactive reservoir management is essential for extending the plateau of the field, which remains the single most important contributor to Aker BP's cash flow. Furthermore, the Alfheim and Edvard Grieg hubs demonstrated high reliability, benefiting from continuous investment in digitalized maintenance and subsea tieback optimizations. The successful startup of Solvay Phase 2 in January 2026, which occurred on time and on budget, provides immediate incremental production that will help mitigate the broader portfolio decline projected for the first half of 2026.
Financial results, navigating impairment and cash flow strength. The financial narrative of Q4 2025 is one of two distinct realities: a reported net loss driven by accounting adjustments, and a record-breaking year for underlying cash generation. Aker BP reported a net loss of $145 million for the quarter, a significant reversal from the $562 million profit recorded in the same period the previous year. The impairment mechanism. The reported loss was primarily a result of $944 million in impairment charges recognized during the quarter. These charges were triggered by the company's decision to lower its long-term price assumptions for oil from $75 to $73.50 per barrel, and natural gas from 0.65 pounds per therm. This downward revision in price expectations, coupled with increased cost estimates for certain development projects, necessitated a write-down of technical goodwill, particularly related to the Johan Sverdrup field. While these impairments are non-cash in nature, they reflect a more conservative outlook on future asset profitability. For the full year 2025, impairments totaled $2.02 billion, which dragged the annual net profit down by 93% to $132 million.
Cash flow and balance sheet. In contrast to the net loss, Aker BP's cash-generating capacity remains at historic levels. The company reported record annual operating cash flow of approximately $7 billion, or $11 per share, an increase from $10 per share in 2024. This record cash flow provides the necessary liquidity to fund the massive $6.2 to $6.7 billion capital expenditure program slated for 2026. The company's balance sheet, while carrying higher debt, remains managed within healthy parameters. Net interest-bearing debt rose to $7.09 billion by the end of 2025, up from $6.07 billion earlier in the year. This increase was partly due to a $1 billion bond issuance in October 2025, intended to ensure the company has sufficient dry powder for its upcoming investment peak. The leverage ratio subsequently increased to 0.63, which remains well below the levels seen during previous market downturns and suggests significant remaining financial flexibility. The capital investment cycle. Aker BP is currently executing one of the most ambitious development programs in the history of the Norwegian oil and gas industry. These projects are designed to replace the natural decline of mature fields and propel the company into a new era of high-margin production.
Valhall PWP Fenris. Cost escalation and scope expansion. A significant focus of the Q4 report was the updated investment estimate for the Valhall PWP Fenris development. The total project cost has been revised upward to $7 billion, an increase from the previous estimate of $5.9 billion. This 19% surge is the result of several converging factors. Value-enhancing scope changes. Approximately one-third of the increase is directly related to the expansion of the drilling program by 5 additional wells. This expanded scope is expected to increase recoverable volumes by 30-35 MMBOE, significantly improving the project's long-term economics. Market inflation and supply chain pressures. The remainder of the increase reflects higher-than-expected inflation in labor and materials, as well as the need to utilize additional construction yard locations to protect the project's 2027 startup schedule in a tight supplier market. Currency fluctuations. The weakening of the Norwegian krone against the US dollar has increased the nominal cost in NOK, although this has a limited impact on the company's USD-denominated financial reporting.
Despite the higher capital requirement, the project maintains its strategic importance as a hub for future gas discoveries and a driver of lifetime extension for the Valhall area.
The Yggdrasil development continues to progress according to plan, with jackets installed and drilling operations already underway. This project is being developed as a digital-first field, utilizing extensive digital twins to optimize both the construction phase and future operations. The goal is to reduce operational costs and maximize recovery through real-time data integration, a strategy that Aker BP believes will set a new global standard for the industry. The acceleration of the Skarv satellites and Utsira High developments into 2026 is a notable operational win, as it pulls forward cash flows from smaller, high-return tieback projects. This fast-track capability is a core competency that allows Aker BP to remain nimble even while managing large-scale infrastructure projects. While the market often focuses on production figures, Aker BP's exploration performance in 2025 provides the strongest evidence for the company's long-term sustainability. The company participated in all three of the largest discoveries on the NCS during the year, adding a net total of over 100 million barrels of recoverable resources.
The Loffen-Langemann gas discovery in the fourth quarter was the final major success of the 2025 campaign, with estimated resources ranging between 30 and 110 million barrels. This discovery is particularly important because it strengthens the growth platform around existing hubs, allowing for high-margin subsea tiebacks rather than requiring expensive new greenfield infrastructure. This exploration alpha allows Aker BP to organically replenish its reserve base at a cost significantly lower than that of acquisitions. For 2026, the company has allocated $400 million to continue this momentum, with a specific focus on the Utsira High area, where rig capacity has been strategically concentrated to capitalize on known geological trends. The 2026 Strategy Update, Navigating the Production Valley. The 2026 Strategy Update provides a clear-eyed view of the challenges and opportunities ahead. Management has been transparent about the production valley that will occur, as mature field declines precede the startup of major new projects in 2027.
Management expects 2026 production to fall within the range of 370 to 400 membo PED, which is a step down from the 420 membo PED average of 2025. This temporary dip is a natural consequence of the company's investment cycle and is anticipated to be followed by a sharp increase to approximately 525 membo PED by 2028. Operating costs are also expected to rise to approximately $8 per barrel in 2026, up from $7.3 per barrel in 2025. This increase is driven by lower overall production volumes, reducing the economies of scale, and persistent inflationary pressures across the supply chain. However, $8 per barrel remains among the lowest production costs globally, ensuring that the company's cash flow remains highly resilient to fluctuations in oil prices. The board's approval of a 5% increase in the quarterly dividend to 66.15 cents per share is a vital signaling mechanism. It communicates to the market that management views the current high expenditure phase as sustainable and that the long-term cash flow outlook remains strong despite the temporary production decline and non-cash impairment charges.
Aker BP is not just producing oil and gas, it is attempting to reinvent the organizational model of an upstream company. The Q4 report highlighted the company's expanded use of AI-assisted subsurface tools and real-time drilling technology to achieve time compression in field development. The company's alliance model, a deep integration with partners like Aker Solutions, is a critical component of its strategy to manage costs and schedules. By sharing data and aligning incentives, Aker BP and its partners can avoid the adversarial relationships that often plague large-scale engineering projects. Aker Solutions' record revenues in 2025, largely supported by the Aker BP Alliance, demonstrate the mutual benefits of this model. This collaborative approach is essential for navigating the current tight supplier market, where competition for yard capacity and skilled labor is intense. Long-term market outlook. Aker BP's global thesis. For the first time, Aker BP released a quantified long-term oil demand outlook as part of its strategy update. This report posits a base case where global oil demand continues to grow by roughly 0.7 million barrels per day annually, reaching 112 million barrels per day by 2035. The company's thesis is built on the belief that while road transport demand will peak around 2030, growth in petrochemicals and aviation will more than offset the decline in the transport sector. Furthermore, Aker BP suggests that the adoption of electric vehicles may be slower than previously anticipated due to policy shifts and consumer behavior, particularly in the US and Europe.
This bullish outlook on long-term demand justifies the company's massive investment in long-cycle offshore projects, as it anticipates a continued need for high-quality, low-emission barrels for decades to come. Conclusion: Aker BP's Q4 2025 report and 2026 strategy update delineate a company that is navigating a high-stakes transition. The optical weakness in the financial statements, caused by non-cash impairments, should not be confused with fundamental operational decay. On the contrary, the record operating cash flow and extraordinary exploration success suggest that the company's long-term value proposition is being systematically strengthened. The primary challenge for Aker BP in 2026 will be the disciplined execution of its project portfolio. With the Valhall PWP Fenris cost escalation already in the public domain, the market will be hyper-focused on the progress of the Yggdrasil development. Any further significant cost revisions or schedule delays could erode investor confidence in the alliance model and the digital twin strategy.
For investors, Aker BP remains a core exposure for those seeking high-quality oil and gas production with a resilient dividend. The 2026 production valley should be viewed not as a sign of decline, but as the necessary preparation for the high growth phase starting in 2027. The company's first long-term demand outlook provides the necessary intellectual framework to justify this strategy, suggesting that Aker BP is positioning itself to be one of the most efficient producers in a world that will continue to demand over 100 million barrels of oil per day for at least the next decade. Management's ability to maintain a 5% dividend growth rate while investing nearly $7 billion annually is a remarkable feat of capital allocation. If Aker BP can successfully deliver Yggdrasil and Valhall PWP Fenris on their revised schedules, the company is well on its way to achieving its goal of producing over 500,000 BOEPD into the 2030s, making it a durable player in the global energy landscape.
Addendum: Deep dive: the mechanics of the Norwegian petroleum tax regime and impairment effects. To fully understand why Aker BP can report a net loss while generating $7 billion in cash, one must examine the specific mechanics of the Norwegian petroleum tax system. The effective tax rate of 137% in Q4 2025 is a staggering figure that requires detailed explanation for professional peers. In Norway, oil and gas companies are subject to a marginal tax rate of 78%. However, the system is designed to encourage investment through immediate expensing of capital expenditures and the carry forward of losses. When Aker BP takes a non-cash impairment on technical goodwill, this impairment is not fully tax-deductible in the same way an operating expense would be. Technical goodwill arises primarily from business combinations, like the London Energy merger, and represents the difference between the purchase price and the fair value of the assets, often tied to the deferred tax liabilities that come with the assets. When the price of oil is revised downward in the company's long-term models, the recoverable amount of the assets drops. If this drops below the book value, an impairment is recognized. Because technical goodwill write-downs often do not carry a corresponding tax shield, they inflate the pre-tax loss relative to the tax expense, leading to an effective tax rate that can exceed 100%.
Aker BP is essentially creating a synthetic growth story for its shareholders. In a traditional E&P model, a production decline of nearly 10% from 420 to 370 MBOEPD would typically lead to a dividend cut or at least a freeze. By increasing the dividend by 5% during this decline, Aker BP is using its balance sheet and its record 2025 cash flow to bridge the gap for investors. This strategy relies on the markets willing to look through the 2026 production valley to the 2027-2028 peak. If the 2027 project startups were to be delayed, the synthetic growth story could unravel, as the dividend would then be funded by increasing debt rather than future production. This makes the execution of the Yggdrasil and Valhall projects not just an operational goal, but a fundamental requirement for the company's equity valuation. Asset specifics: the Alvheim hub's longevity. The Alvheim area remains a masterclass in hub-and-spoke development. In Q4 2025, the area continued to benefit from the Tyrving and Cobra East Gecko (KEG) developments, which have revitalized the production profile of the Alvheim FPSO.
The KEG project, in particular, was cited as a model for low-cost, low-emission tiebacks that keep hub cost low even as the main fields decline. The Alfheim hub's ability to maintain high efficiency, 96% across the portfolio, often implies Alfheim is even higher, is critical because it carries a lower break-even than the newer, larger developments. This legacy cash flow is what actually funds the growth capex for projects like Yggdrasil.
The role of Aker Solutions and the industrial ecosystem. The interdependence between Aker BP and Aker Solutions cannot be overstated. With Aker Solutions reporting a 19% revenue increase and a stock price surge of 6.4% following its own Q4 report, it is clear that the Aker ecosystem is thriving. For Aker BP, a healthy Aker Solutions is a strategic asset. The alliance model ensures that Aker Solutions' 5,000-strong engineering workforce is prioritized for Aker BP projects. In a market where competitors are struggling to find engineering capacity for their offshore projects, Aker BP's secured access to this talent pool is a massive competitive advantage. It is one of the primary reasons why management remains confident in the 2027 startup dates, despite the broader industry's cost overruns. The use of digital twins for Yggdrasil is more than just a 3D model of the platform. It represents a fundamental shift in how offshore work is conducted. By having a live digital replica that integrates real-time sensor data with engineering drawings, Aker BP can move more of its workforce to shore. This onshore-centric operational model reduces the number of people who need to be flown to offshore platforms, which is both safer and significantly cheaper. It also allows for faster troubleshooting by a wider range of experts who can access the twin from anywhere in the world. This is the time compression that CEO Hersvik frequently references, the ability to make decisions in minutes that used to take days of offshore visits and data gathering.
Strategic outlook, the 112 million barrel demand thesis. The decision to publish a long-term oil demand outlook is a bold strategic move. Most European oil majors, like Shell or BP, have been distancing themselves from long-term oil growth forecasts in favor of energy transition scenarios. Aker BP is taking the opposite approach, doubling down on the resilience of oil demand. By forecasting demand at 112 million barrels per day in 2035, significantly higher than the current 105, Aker BP is sending a message to the capital markets. We are not a sunset company. We are a growth company in a growth market. This outlook is crucial for maintaining the interest of long-term institutional investors who might otherwise be wary of the terminal value of an oil-focused producer. The focus on petrochemicals and aviation as the strongest contributors to growth is a nuanced take that acknowledges the inevitable decline of passenger vehicle oil demand while arguing that the global economy's physical needs for materials and travel will continue to expand. This data-driven view provides the intellectual foundation for the company's massive $288 billion gross investment portfolio.
Final evaluation of the positive and negative dichotomy. The Q4 2025 report is a classic example of a transitional earnings release. The positives are structural and operational. Record cash flow of $7 billion, 100 MMBOE of new discoveries, a dividend that is growing despite the valley, digitalization that is actually being deployed at scale. The negatives are cyclical and accounting-based, non-cash impairments, temporary production decline, cost inflation in a tight yard market. Aker BP is intentionally trading short-term bottom-line neatness for long-term dominance on the NCS. The company is using its peak production years, 2024-2025, to fund a future where it will be the most efficient and most digitally advanced producer in one of the world's most stable jurisdictions. As long as the 2027 projects remain on track, the negatives of the Q4 report will likely be forgotten as the production valley is crossed and the 525 megaBOE update target comes into view.